The impact of this downturn on private credit, of course, is the $64,000 question, or actually with the size of our market, the $800 billion question. And the answer really has to come in more than one part. The first answer in terms of the impact on the market is a lot of cloud, what you might call the fog of war. We don't really know whether defaults are going to be coming in a surge next year. So far, you'd have to say, here we are in December 2020, that the impact of the crisis has actually been less than a lot of people feared. We haven't yet had the kind of surge in defaults which you would associate with a demand and supply shock that we've had. But the market is going into next year very wary about what the aftershocks might be of an economic contraction, and also where corporate balance sheets are in the SME and mid-market sector. So the way to say it, I think, is this is the end of the beginning, not the beginning of the end. The way investors look at private credit is really over a 10-year time frame. If you come into one of the funds in our market, you'd typically be allocating to probably in the number of companies you're exposing to. If you go into a private credit fund, is anything between 15 and perhaps up to 100 different companies. You're enabling an asset manager to make 5, 7, or even 8-year loans to companies. So in terms of appetite, investors, particularly institutions, I think have taken this on the chin, if you like, and they're thinking, well, we were always in the long term. So the appetite is still there. Having said that, there has definitely been a pause where people have thought, let's just hold back on what we were planning maybe for 3 months, 6 months to see how this pans out. So I would say there's been, if you like, a glitch in time. And we're seeing this, aren't we? That kind of 2020 almost didn't happen. And we can see this in lots of ways. There was, the sporting competitions that didn't happen are now going to happen in 2021. Pretty similar in our market. A lot of allocators who are committed long-term to the market have been just waiting to see how this pans out. So I would predict now, of course, predictions are always dangerous, but I'd predict now that you will probably see a bigger fundraising period in Q1, Q2 2021 than we did in Q1, Q2 2019, because the 2020 allocations will now come back on stream. Yeah, so in my answers just now, I was relatively, cautiously optimistic that demand is still there, fundamentally still there. We have a yield producing asset class with long-term diversification within it. We also have a lot of professional investors, up to now 800 billion or 1 trillion of outstanding institutional investment. But if you ask what will this crisis do, if anything, to change the market, there I have both a more optimistic view about what the crisis might have made us learn, but also a little bit more of a cautious view. So let's take the good news first. In terms of what we've learned a lot in this crisis about how we can continue to collaborate, continue to communicate, a bit like we are now, continue to share ideas. And we've done that, I'd say we've muddled through. On the other hand, it has exposed the lack of data, the lack of organized, transparent data in this market. And really, the private credit market since the last crisis has been mostly based on one-to-one interaction and the forging of relationships between counterparts. But I think what this has really shown, the crisis this year, is that people have been wanting to have more data. How are SMEs and mid-market companies responding? And really, there hasn't been the kind of organized data flow that investors would have needed. So I think it's going to make us realize, or it has made us realize, that from going forward, even if we get back into the conference circuit, which Super Return does so well, even if we get back into the one-to-one roadshows and the flying around the world, it has been exposed during the last 6 months that really we need better, more transparent, less asymmetric data so that investors can really make rational long-term decisions. Of course, realizing that was a problem is part of the solution. So I think what you'll see over the next year or two is an acceleration of the ways in which we professionalize the use of data in our market. Yes, actually I do. Structural change happens when it's necessary, or when certain players in a market make it necessary for themselves. I think we're in the first of those two situations here, where we do have a situation where most of the money is still being raised by between 10 and 20 major players. That's because those guys have done well. Some of them have been operating for 20 years now, even 25 years. So I'm not saying that this oligopoly, if you like, of large managers do not deserve the capital they're raising. But I think it's a danger for them and for investors if we continue to have too much of a narrow fundraising base. Those managers are going to need to deploy very big funds. We're talking 5 to 10 billion in fund size. But they're not going to be doing many more transactions. They're going to be doing bigger and bigger transactions. And we have seen pricing deteriorate before this crisis. We saw pricing already deteriorating, and we saw capital structures looking a little riskier. So one of the structural changes which I think is going to be forced on us, and something which will in the long run be beneficial, is that investors will start gravitating towards maybe more specialist managers, more regional managers, because they themselves have been professionalizing well over the last 5 or 10 years. And I think you'll start to see that diversification in the market that we need. If we don't get that, then we'll have another period of too much money chasing a few large deals. A market, whether it's private or public, of course, is going to come under scrutiny from both the people in the market and regulators and those who feel that they have an interest in how that market performs. And the people who have an interest in how our market performs include the investors, the asset managers, the communities where the portfolio companies are operating, regulators, governments, the media like yourselves, conference providers, service providers, and all of us who are professionals who want to be part of something which we can be proud of. And one of the issues that we have at the moment, one of the biggest issues that we all see in the newspapers every day, is one of inequality, for example. So we've had some very populist politicians coming and going, both in the UK and the US and all over Europe and Asia. And one of the consistent themes has been that at the moment, capitalism in its broadest sense is not serving as many of its citizens as either it used to or as it should do. And we are now a big part of capitalism, with up to $20 trillion projected to be coming into the alternative investment market, and with a good proportion of US and European companies either owned by private market players or invested in by private market players. We're now core to what people see as capitalism. And whether we like it or not, we're going to be under increasing scrutiny as to whether what we do benefits all of those lists of stakeholders that I just set out. Now, of course, we're responding to that with impact funds and ESG and all of the things which, in a way, I would call necessary innovations. But there is still a fundamental question about legitimacy and whether our market can continue to be as unregulated as it is. I'm, of course, a big believer in that we should be unregulated and that actually generally we're doing good things. But it's back to one of my answers earlier. If we can get more transparency into our market and more diversification, then all of those stakeholders will see how private markets are supporting lots of different parts of the real economy, put it that way. And we absolutely need to be seen to be providing a solution for the real economy, where growth has been pretty anemic. Now we've had a big contraction during this crisis. And let's hope that the private markets can continue to build themselves as a solution in the real economy. Yeah, that's a great question. And there is going to be increasing investor demand. We're going to have low interest rates. We're going to have a search for yield. So the game continues where GPs, as we call them, will need to deploy well, and they'll need to. So how can they keep up with the amount of deployment? So one of the main answers there is that they're going to have to diversify portfolios better, and investors want that. So there are certain regions in the world where they could expand more. We've seen more deployment in the US and in Northern Europe. I think you're going to see more deployment around the Mediterranean and Southern Europe. There's going to be more activity, I believe, in Asia over the next 5 years in terms of deployment as well as raising capital. And there are more and more managers who are bringing very professional processes in the emerging markets. The other way to do it is they're going to have to spend more time with smaller businesses in the real economy, as I mentioned earlier, which, if we're in this famous K-shaped recovery where certain sectors are doing well and other sectors are doing less well, well, one of the reasons why certain sectors are doing less well is literally because of capital supply to those sectors. So some managers will find a great opportunities, I believe, if they have the setup to go into the less obvious parts of the economy and provide private capital where not only is it needed, but it will turn out to have been a solid investment for them. And that may mean that we're playing our role perhaps in smoothing that K shape, which at the moment looks like it's really developed, it's really benefiting certain parts of the economy and not others.